In the last section, we used the example of a water tank to explain some simple risk concepts, such like risk capacity, risk appetite, and risk exposure. It's not just the value of a bank's risk exposures that is important, but also its risk profile. A risk profile shows the breakdown of risk exposures for a particular risk type, using various measures that provide information on, for example, current or possible risk concentrations. In common term, having too many eggs in one basket is generally a higher risk. High risk exposures. The risk of loss is not a linear function. For example, a USD 100 million portfolio of mortgages loans with an average loan to value LTV ratio of 80% is likely to be seeing higher losses than the one with an average LTV of 60%. The measures used vary from one risk type to another, but include a mix of the following. For example, absolute values such as currency amounts. For example, relative values that express absolute values as a percentage of total. The risk profile can be assessed by reporting in a variety of ways and comparing values against risk appetite thresholds. Some examples of dimensions that can be used to assess the risk profile of a credit risk exposure are described below. Comparing such reports over time provides useful information about trends in risk. For example, performing status, reporting the value of customer exposures that are at risk in arrears, broken down by days past due, so DPD, and in default provides information on the level of likely losses. Customer, reporting by the value of exposure highest to lowest, given an indication of customer concentration risk. This would be high if, for example, a single customer exposure is in excess of USD 1 billion, or exposure to the top 10 customers is greater than, for example, USD 3 billion. And finally, for example, industry. Some industries are considered higher risk than others. So reporting exposure by industry classification shows whether there are industry concentration risks, for example, greater than USD 1 billion in one industry, or risk appetite for higher risk industries, which may be modest or zero, is breached. Using absolute values can only provide so much information about a bank's risk profile, so other measures should be considered. For example, having an exposure of USD 3 billion to the top 10 customers would be a concern if it amounted to 50% of the bank's total credit exposure. But on the other hand, would probably not be a concern if it was less than 10%. Similarly, breaking a portfolio down by credit grade will provide a different perspective on risk within a portfolio. Thanks for watching. We'll be looking at risk types, its advantages and disadvantages in the next session.